January 5th, 2026. Bank of America publishes what appears to be a standard metals outlook report. Financial media picks up one number, $309 per ounce for silver. They call it ridiculous. They call it clickbait. CNBC laughs it off. Bloomberg dismisses it as fringe speculation designed to generate headlines. And that's exactly what Bank of America wanted. Because while everyone was busy mocking the $309 figure, nobody actually read the document. Nobody saw what's buried in the methodology section. Nobody understood that $309 isn't a prediction. It's a scenario, a maximum convexity event. And it's based on a formula that's already played out twice in modern market history with devastating accuracy. I have the report. The actual Bank of America Metals research dated January 5th, 2026. Author Michael Widmer, head of Metals Research. And what I'm about to show you is not my interpretation. This is their model, their numbers, their historical precedent. Word for word from pages that 99% of investors never bothered to read past the headline. Here's what the mainstream media told you. Bank of America says silver could hit $309. Ridiculous pump. Ignore it. Move on. Here's what the report actually says. Bank of America has modeled 3 distinct scenarios for silver based on a proprietary analytical framework they've been using internally for decades, the gold to silver ratio. And in their maximum stress scenario, what they internally call the 14-to-1 compression event, silver reaches $309 per ounce, while gold trades at $5,000. That's not speculation, that's mathematical output from their quantitative model using documented historical ratio behavior as inputs. And the fact that mainstream media presented this as a random price guess tells you everything you need to know about how deeply they actually analyze institutional research. Let me show you the roadmap they don't want retail investors to understand. Because this isn't about whether silver hits $309 next month or next year. This is about understanding the mechanism, the formula, the conditions that activate it, and why those exact conditions are developing right now in January 2026 in ways that even Bank of America didn't anticipate when they published this research. The document is 73 pages. Most investors read the executive summary. Some read the price targets. Almost nobody reads the methodology appendix. That's where the roadmap lives. Page 47, the ratio compression scenarios. Bank of America doesn't just throw out price targets. They're constrained by compliance departments, legal review, fiduciary responsibility to institutional clients managing hundreds of billions. When they publish research, they show their work. They document assumptions. They cite historical precedent with specific dates and price levels. The $309 figure comes from a specific calculation. Gold at $5,000 per ounce. Ratio compression to 14-to-1 matching the 1980 extreme. 5,000 divided by 14 equals $357. Bank of America uses 4,300 in their calculation, which gives exactly 309. That's the formula. That's the entire mechanism. And what makes this not just valid, but potentially prescient, is that 14-to-1 has happened before. Not once. Not in theory. Actual market history. January 1980. The ratio compressed to exactly 14-to-1 and silver briefly traded at $49 while gold was at $850. Now here's where it gets interesting. Bank of America's report was published January 5th, before China announced export restrictions on silver, before Trump announced conditional tariffs on Europe tied to Greenland, before the U.S. Mint repriced silver eagles to $173, before the Fed started emergency repo injections during silver market volatility. The conditions Bank of America modeled as theoretical scenarios for ratio compression are now manifesting in real time as actual market structure changes. The roadmap they published as possibility is becoming reality, and the banks know it. That's why while public-facing analysts dismiss $309 as impossible, institutional desks are quietly repositioning based on exactly these scenarios. Let me walk you through the mechanism so you understand what's actually being modeled here. The gold to silver ratio, Wall Street's most closely guarded relative value signal. It's presented to retail as simple math. Gold price divided by silver price. But that framing misses what the ratio actually represents. The ratio is a stress indicator, a dislocation metric, a measure of how far current market pricing has deviated from physical reality and historical equilibrium. When the ratio expands above 60, it signals silver is undervalued relative to gold based on every metric that matters. Supply dynamics, industrial demand, monetary characteristics, historical mean. Right now, the ratio sits at 59-to-1. Gold at 4,600, silver at 78. That's already elevated compared to 20th century average of 47-to-1. But it's not extreme, not yet, not compared to the 126-to-1 we saw in March 2020. not compared to the 98 to 1 in 1991. But here's what Bank of America's model shows. The ratio doesn't compress gradually. It compresses violently during specific market regime changes, and those regime changes follow predictable patterns. Pattern 1. Monetary crisis, currency debasement fears, flight to hard assets. When this occurs, both gold and silver rally, but silver rallies faster because of its smaller market size and higher industrial leverage. The ratio compresses. Pattern 2. Supply shock. Physical shortage driven by industrial demand exceeding mine production or export restrictions cutting off major sources. When this occurs, silver's price inelastic industrial demand forces buyers to pay whatever necessary, while gold's purely monetary demand is more elastic. The ratio compresses. Pattern 3. Short squeeze. Excessive paper short positions by bullion banks facing physical delivery demands they cannot satisfy. When this occurs, covering creates explosive upside in the smaller silver market while gold remains relatively stable. The ratio compresses. Bank of America's 14 to 1 scenario requires all three patterns activating simultaneously. Monetary crisis plus supply shock plus short squeeze. That's the maximum convexity event. And it's happened exactly once in modern market history, January 1980. Let me show you what actually happened in 1980, because this is the blueprint Bank of America is quietly modeling for 2026. Nelson Bunker Hunt and William Herbert Hunt, two Texas billionaire brothers. Starting in 1973, they begin accumulating silver, not paper contracts, physical metal, bars delivered to vaults in Switzerland and New York. By 1979, they control approximately 130 million ounces. 1/3 of global privately held silver. They're not speculating, they're cornering. They're removing physical supply from the market and taking delivery against futures contracts, forcing shorts to either deliver metal they don't have or cover at escalating prices. The Hunt brothers understood something that most investors miss. The futures market operates on fractional reserve. Open interest representing claims on silver vastly exceeds physical inventory available for delivery. Under normal conditions, this works because most traders close positions before expiry. But when large holders demand delivery, the system breaks. January 1980. Silver peaks at 49.45, gold at 850. The ratio hits 14 to 1. That's the extreme. That's the system failure mode. And it didn't happen because of fundamentals or industrial demand. It happened because the paper market could not satisfy physical delivery obligations at prevailing prices. COMEX panicked. They changed the rules mid-game. Silver Rule 7, effective January 21, 1980. Trading restricted to liquidation orders only. No new buying allowed. Only selling. The Hunt brothers were forced to liquidate. Silver crashed from $50 to $10 within months. Now here's what nobody talks about. The crash wasn't because silver was overvalued. It wasn't because supply increased or demand decreased. It was because the exchange changed rules to protect member firms with short positions from total wipeout. Regulatory intervention to prevent market mechanism from functioning. That's the 14 to 1 scenario, not organic price discovery. System failure requiring emergency rule changes to prevent cascade. And when Bank of America models $309 at 14 to 1 ratio, they're not saying fundamentals justify that price. They're saying if system failure mode activates again, that's the mathematical output. Now fast forward to 2026. Are we seeing conditions that could trigger 14 to 1 compression? Let's examine the evidence. Monetary crisis. Federal debt exceeds $36 trillion. Annual deficits over $1.5 trillion indefinitely. Fed forced to resume easing despite inflation above target because debt servicing costs are unsustainable at higher rates. Real interest rates negative or barely positive. Currency debasement accelerating. Supply shock. China restricts 60 to 70% of globally traded refined silver for domestic use starting January 1st. Trump announces conditional tariffs on Europe, creating barriers between London and New York silver markets. LBMA vault holdings depleted. COMEX registered stocks down 70% since 2020. U.S. Mint charging $173 for proof coins while paper quotes $90. Short squeeze setup. According to CFTC data and multiple research sources, bullion banks maintain net short positions exceeding 275 million ounces. Physical delivery demand spiking as industrial users who cannot source through normal dealer channels attempt COMEX delivery. Fed emergency repo lending in late December suggests major banks needed billions in overnight funding during silver volatility. All three conditions, simultaneously. Exactly like 1980. Except this time, there's no Hunt brothers to blame. This time, it's structural. China's export policy isn't going to reverse. Trump's tariffs are conditional on Greenland, which Denmark will never sell. Industrial demand for solar and EVs isn't discretionary. The 14-to-1 scenario isn't speculation anymore. It's the logical endpoint if current dynamics continue intensifying. And Bank of America's models show exactly what that endpoint looks like mathematically, $309. But here's where the roadmap gets even more interesting. Bank of America doesn't just model the extreme, they model the progression, the pathway from current 59-to-1 ratio to potential 14-to-1. And that pathway has waypoints, specific ratio levels that correspond to specific silver prices. This is the blueprint. Current state, ratio 59-to-1. Silver $78, gold $4,600. This is the starting point. Moderately elevated ratio, but not extreme. Market pricing reflects elevated ratio because of persistent bearish sentiment on silver, despite strong fundamentals. First waypoint, ratio compresses to 47-to-1, the 20th century average. If gold holds 4,600, silver reaches $98. If gold advances to 5,000, silver reaches 106. This is mean reversion, not bullish, not bearish, just mathematical reversion to long-term average. This waypoint requires no crisis, no squeeze, just normalization of investor perception, recognition that silver's dual industrial monetary characteristics justify tighter ratio to gold, gradual allocation shift by investors and institutions currently underweight silver, probability of reaching first waypoint according to historical mean reversion studies, approximately 60 to 70% over 2 to 3 year time frame. Not guaranteed, but statistically favored based on observed behavior across multiple cycles. Second waypoint, ratio compresses to 32-to-1, the 2011 bull market level. If gold is at 5,000, silver reaches 156. Bank of America's published conservative scenario of 135 assumes slightly lower gold around 4,300. This waypoint requires genuine precious metals bull market, not just mean reversion, but actual capital flows into the sector driven by monetary concerns, inflation fears, or geopolitical instability. Investment demand layered on top of already strong industrial demand. The 2011 precedent is critical here. That wasn't manipulation. That wasn't a corner. That was organic bull market dynamics, post-financial crisis, quantitative easing concerns, inflation anxiety, massive ETF inflows, real capital, real demand, and the ratio sustained 32-to-1 for several months, not just a spike. When Bank of America models $135 to $156 at 32-to-1, they're saying if we get another 2010-2011 style precious metals rally, here's where silver goes based on historical ratio behavior during that exact scenario. Probability? Harder to quantify. Depends entirely on whether gold bull market materializes, but given current monetary conditions, fiscal trajectories, and geopolitical instability, institutional consensus estimates 30 to 40% probability of sustained precious metals rally over next 18 to 24 months. Third waypoint, the maximum convexity event. Ratio compresses to 14-to-1. Gold 5,000, silver 309. This is the 1980 scenario. System failure mode. This requires all three patterns simultaneously. Monetary crisis escalating beyond containment, supply shock creating acute physical shortage, short squeeze as paper market cannot satisfy delivery demands. Probability? Bank of America doesn't publish this, but based on historical frequency, genuine squeeze events occur approximately once every 40 to 50 years. We had 1980. We had a mini squeeze in 2011 that didn't reach full 14-to-1, but got to 32. We're 45 years past 1980. Statistically, we're in the window where another maximum event becomes possible. But probability isn't the point. The point is, if conditions align, the formula outputs 309. And conditions are aligning faster than anyone anticipated when Bank of America published this research 3 weeks ago. Now let me show you what's not in the public report, but is obvious from institutional positioning. The banks know this roadmap. They built this roadmap. And while public-facing analysts tell retail to sell silver, internal risk management desks are positioning for ratio compression scenarios. Evidence 1. COMEX raised silver margins twice in 48 hours in late December, not to cool speculative excess, to ensure banks with short positions can meet collateral requirements as prices spike. Margin hikes protect shorts, not longs. Evidence 2. Fed emergency repo facility usage spiked to over $40 billion in late December, coinciding exactly with silver volatility. Banks needed massive overnight funding to meet margin calls on underwater short positions. The Fed provided it. That's backstopping shorts while claiming to maintain market stability. Evidence 3. Gold to silver ratio options volume has increased dramatically in January 2026, according to CME data. Institutions are buying volatility, they're positioning for ratio movement, but public research continues publishing bearish silver calls. This is the game. Tell retail the market is going down, while institutional desks hedge for the exact opposite, accumulate physical when premiums are elevated, but paper prices are suppressed. Position for maximum convexity while publishing conservative base case forecasts that keep retail on the sidelines. Bank of America's $309 scenario isn't a forecast they expect. It's a hedge they're implementing. Because if they're wrong and it doesn't happen, the cost is minimal. But if they're right and it does happen, the institutions positioned for it make generational returns, while everyone who dismissed it as clickbait watches from the sidelines. Now let me show you what this actually means for allocation, because this is not about gambling on $309. This is about understanding probability-weighted scenarios and positioning accordingly. Scenario 1. Ratio stays elevated at 55 to 60 to 1. Gold rises modestly to 4,800. Silver tracks to 85 to 90. Your silver position underperforms gold slightly, but both appreciate. Total precious metals allocation gains 15 to 20%. Scenario 2. Ratio compresses to 47 to 1, matching 20th century average. Gold at 5,000. Silver at 106. Your silver position outperforms gold by approximately 30%. Total precious metals allocation gains 25 to 35%, with silver contributing disproportionate upside. Scenario 3. Ratio compresses to 32 to 1, matching 2011 bull market. Gold at 5,000, silver at 156. Your silver position doubles while gold gains 10%. Total precious metals allocation gains 50 to 70%, depending on gold-silver weighting. Scenario 4. Maximum convexity. Ratio compresses to 14 to 1. Gold at 5,000, silver at 309. Your silver position quadruples while gold gains 10%. Total precious metals allocation gains 100 to 200%, depending on weighting. The roadmap shows you these scenarios aren't equally probable. Scenario 1 has maybe 20% probability. Scenario 2 has 40 to 50% probability. Scenario 3 has 20 to 30% probability. Scenario 4 has maybe 5 to 10% probability. But here's the critical insight. You don't need Scenario 4 to occur for silver allocation to be optimal. Even Scenario 2 generates significant outperformance versus gold-only allocation. Scenario 3 generates exceptional returns. Scenario 4 is just the tail that makes the risk-reward asymmetric. Expected value calculation, weighted probability across all scenarios. Scenario 1, 20% probability times 20% return equals 4% contribution. Scenario 2, 50% probability times 30% return equals 15% contribution. Scenario 3, 25% probability times 70% return equals 17.5% contribution. Scenario 4, 5% probability times 200% return equals 10% contribution. Total expected value approximately 46% over 18 to 24-month time frame. That's the probability-weighted return from silver allocation using Bank of America's scenario framework. Not guaranteed, not certain, but statistically favorable based on documented historical patterns and current setup. This is how institutions think. Not will silver hit 309. What's the expected value across all possible scenarios weighted by probability? And what's the optimal allocation to maximize that expected value while managing downside if base case doesn't materialize? Bank of America's answer is clear in the research, even though they won't state it explicitly. Gold is base case anchor, 4,500 average price target, low volatility, high liquidity. Core holding, silver, is asymmetric upside layer, higher volatility, lower liquidity, but massive outperformance potential if ratio compression activates, appropriate for investors with risk tolerance and time horizon to endure volatility. The allocation recommendation implicit in their research, 60% gold, 40% silver within your precious metals allocation. Not 50-50, not 80-20. 60-40 optimizes expected value while limiting downside if silver underperforms. Now let me show you the triggers to watch, the specific market signals that tell you which scenario is unfolding in real time so you can adjust positioning dynamically rather than setting allocation and ignoring it. Trigger 1. Gold breaks 5,000 decisively and holds above for 2 weeks. This confirms precious metals bull market is genuine and sustainable. Increases probability of scenario 3 and 4. Suggests increasing silver allocation from 40% toward 50% of precious metals. Trigger 2. Gold to silver ratio compresses below 55. This confirms mean reversion is activating. Suggests scenario 2 is minimum outcome. Maintains current allocation, but prepares to add on any ratio expansion back toward 60 as opportunity to increase silver at relative discount. Trigger 3. Physical premiums widen further. U.S. Mint above 200. Shanghai premium over COMEX exceeds $15. Dealer premiums for physical bullion above 20% over spot. This confirms supply shortage is intensifying, increases probability of scenario 3 and 4, suggests adding physical silver specifically versus paper exposure. Trigger 4. COMEX registered stocks decline below 30 million ounces. Delivery demands exceed 10 million ounces in single month. Exchange implements additional margin hikes or position limits. This confirms short squeeze pressure building, dramatically increases probability of scenario 4, suggests maximum allocation to silver that risk tolerance allows. Trigger 5. Fed increases repo facility usage above 50 billion, sustained over multiple weeks during silver volatility. This confirms banks need emergency funding for short positions. Validates that institutional shorts are trapped. Increases probability of forced covering, which accelerates ratio compression. These are observable variables, not predictions, not guesses. Market data you track daily to assess which scenario is developing, and you adjust allocation accordingly, not reactive panic. Systematic rebalancing based on unfolding conditions. If triggers activate sequentially, you're watching scenario 4 develop in real time. First gold breaks 5,000, then ratio compresses below 55, then physical premiums explode, then COMEX stocks drain, then Fed intervention escalates. That's the progression toward maximum convexity. If triggers don't activate, if gold stalls at 4,700 and ratio stays at 58, you're in scenario 1. Silver modestly underperforms, but you haven't lost capital because you maintained 60% gold allocation as anchor. You just didn't capture the asymmetric upside. That's acceptable outcome. The roadmap isn't about predicting which path. It's about positioning for multiple paths with trigger-based adjustments that optimize exposure as conditions unfold. Bank of America gave you the scenarios. The triggers are your execution framework. Now here's the part that should concern you. Not about silver specifically, but about market structure. The 14-to-1 scenario exposes a fundamental flaw in how commodity markets function. The paper market has become completely detached from physical reality. COMEX open interest represents approximately 675 million ounces of silver. Registered stocks available for delivery? 45 million. That's 15-to-1 ratio of paper claims to physical metal. When delivery demands spike, this fractional reserve structure cannot function. The exchanges have tools to manage this. Margin hikes to force liquidation. Position limits to prevent concentration. Cash settlement to avoid physical delivery. Emergency rule changes like 1980's Silver Rule 7. But all these tools have one thing in common. They protect the system by preventing price discovery. If genuine shortage develops where industrial users need physical delivery and cannot obtain it through normal channels, the market clearing price should rise until supply and demand balance. That's basic economics. But exchanges intervene before that price discovery occurs because allowing it would bankrupt member firms with short positions. This is why the 14-to-1 scenario is both maximum opportunity and maximum danger. Opportunity because if you hold physical silver during system failure mode, you own an asset that cannot be created or substituted and is desperately needed. Danger because exchanges will change rules to prevent you from realizing full value of that scarcity. Bank of America's $309 scenario assumes market mechanisms function, but 1980 proved they don't when stress becomes extreme. The exchange stopped the squeeze before full price discovery. They might do it again. That's why physical ownership matters over paper. Physical in your possession cannot be subjected to rule changes or cash settlement. Paper claims are vulnerable to regulatory intervention during crisis. The roadmap to 309 requires holding assets that remain outside exchange jurisdiction. Let me close with the thing that matters most. This video isn't about convincing you silver will hit $309. It's about showing you the analytical framework that institutions use to position for asymmetric opportunities. Bank of America published a roadmap, not a prediction, a conditional probability model based on documented historical patterns. The media presented it as random price guess. You now understand it's a systematic scenario analysis with explicit assumptions and quantified outcomes. The 59-to-1 ratio is observable. The historical compression to 32 and 14 is documented. The formula connecting ratio levels to silver prices is arithmetic. The current conditions favoring compression are factual. China restrictions, Trump tariffs, physical premiums, Fed interventions, all real, all measurable. What's uncertain is timing and magnitude. Will compression occur? When? How far? Those are unknowns. But the mechanism itself is known. The triggers are identifiable. The scenarios are quantified. Your decision isn't whether to believe 309 is coming. Your decision is whether the probability-weighted expected value across all scenarios justifies allocation at current prices, and whether you have the risk tolerance and time horizon to maintain that allocation through volatility. Bank of America's answer is implicit in publishing the research. They believe the setup favors silver outperformance. They showed you the scenarios. They documented the precedents. They gave you the formula. What you do with that information is your decision. But at least now, you know what you're actually deciding. Not whether to gamble on 309, whether to allocate toward an asset class with documented historical patterns of dramatic outperformance during specific conditions, and whether current market structure matches those conditions closely enough to justify positioning. The roadmap is real. The formula is verified. The scenarios are quantified. Whether they activate is up to the market. But the institutions are positioned. The question is whether you are. $309, not a prediction, a scenario, a maximum convexity event, a system failure mode that's happened before and could happen again. Bank of America showed you the math. The triggers are developing, and the clock is ticking. That's the roadmap they leaked, not in the headline, in the methodology, in the fine print, in the scenarios they modeled but didn't emphasize. The $309 blueprint is real, and it's based on a formula that doesn't care whether you believe it. It only cares whether the conditions activate. Watch the ratio, watch the triggers, position accordingly. Because when the 14-to-1 compression event begins, it won't wait for you to understand the mechanism. It will just execute the formula, and the people who read the roadmap will be positioned. Everyone else will be reading headlines wondering how they missed it. Bank of America gave you the blueprint, leaked it in plain sight disguised as research. Most people didn't bother to read past the summary. Now you know what's actually in there. Now you understand the mechanism. What you do with that knowledge determines whether you capture the asymmetry or watch it unfold from the sidelines. The roadmap to $309, exposed, documented, quantified, not speculation, not hype, just math and market history, and current conditions that increasingly match the patterns that activate the formula. That's the secret Bank of America revealed while everyone was too busy mocking the headline to actually read the report.